Welcome to another Series 63, 65, 66 State Law Review session. In this review, we are going to break down 10 questions drawn from Unit 2, the regulation of investment advisory firms and investment advisor reps, Unit 3, the regulation of securities and issuers, and Unit 4, the Uniform Securities Act remedy and administrative provisions. To make the most of this review session, you're going to want to complete each of the 10 questions before we break them down. Now, I think the best way to do that is to actually go to your training center, print out the PDF that has all 10 questions, commit a particular answer to each question. Why is that the right answer? And make the most of it. Why are each of the other choices wrong? Then listen to me breaking it down. Now, if you don't have the opportunity to do that, that's not something that is available to you right now. You want to just watch, that's fine. But really commit to pausing before each question so you can do your analysis. Commit to an answer choice. If you get it right, you get a positive feedback loop. It helps support memory, recall, retention. If you get it wrong, it also, and actually even more so, supports learning, memory, recall, and retention, because it's at that moment when you're feeling that sting and I go and drop that value bomb, that knowledge bomb, I explain the rule or the reg or whatever, that it is going to be the most sticky for you. So if you're getting questions right, that's fantastic. If you're getting questions wrong, that's just opportunity. All right, with that, let's jump right into the questions. Question number 1, which of the following security issues is least likely registered with a state securities administrator? Now, before you even dive into the answer choices, this is a great question for you to project. What kind of securities do require registration with the state? What kind of securities do not require registration with the state? Yeah, exempt securities are not required to be registered with a state securities administrator. So we're going to be looking for an exempt security, least likely registered with the state securities administrator. Classic state law exam kind of question, where they're setting you up and you're going to have to be careful. Are we looking for the least likely or the most likely? Now, what answer choice did you pick? Which is least likely registered with the state securities administrator? I'm going with B, common stock listed on NASDAQ. Those securities that are listed on our national securities exchanges, like the New York Stock Exchange, the American Stock Exchange, Midwest Stock Exchange, the NASDAQ, are exempt as federal covered securities and therefore would be least likely registered with a state securities administrator. Now let's take a look at some of these other choices. Why are they not exempt? Why are they likely to be registered at the state level? Well, common stock that is issued exclusively within state A. If it's exclusively within a particular state, an intra-state offering, then we're likely to register it in that state. How about C? An initial public offering of $8 million in common stock. Now, how many of you saw IPO there and thought, IPO, that's exempt, that's federal covered? And that's not unusual, because in the culture and in the news, when we read about IPOs, we're always reading about them in connection with listing on a national exchange. We're seeing big companies have their IPOs. But small companies doing that intrastate offering, like we saw in Choice A, they'll have an initial public offering too. And if it's only for $8 million, that's pretty small. That's a pretty micro kind of IPO right there. And for that reason, it's probably registering with the state. And D, common stock with an average weekly trading volume of 300 shares over the previous 4 weeks. 300 shares, that's it. On average per week, extremely thinly traded. That's going to be a very small amount of volume and trading, and that's going to be inconsistent with being listed on a national exchange. And so for that reason, D is probably registering at the state level. All right, so I hope that clarified a little bit about what are the exempt securities, don't have to register with the state securities administrator, and what securities do more likely have to register at the state level. Intrastate, small offerings, thinly traded offerings, things that are trading maybe over the counter. All right, question number 2. Do you already have your answer? Fantastic. If not, pause the video, do the question. Question 2 asks us about an individual terminated association with her firm. It was her sole responsibility to notify the administrator of her new status. What type of firm was this individual associated with? With what type of firm was this individual associated with? These are the kind of state law questions that you're going to get. The language is not clear. So what are they asking us? And you skim the answer choices and you see you have broker-dealers and advisory firms, whether SEC registered or state regulated. And that's when the rules should start bubbling up in your mind about, oh yeah, we talked about that depending on who you work for, broker-dealer or investment advisory firm, there are different reporting requirements when you terminate association. If it is the sole responsibility of the individual, what kind of firm were we associated with? Well, we are going to be with a SEC regulated investment advisory firm. Now, how do I always remember that it's the investment advisory firms where only one party has to notify? Because the I looks like a 1. And so only one person has to provide notification of the termination. If it's an SEC regulated firm, that responsibility then falls to the investment advisor rep because the firm doesn't talk to the state securities administrator. The firm is regulated by the SEC, but the individual, the investment advisor rep, is registered with the state. And so the state securities administrator tells the registered person, the investment advisor rep, you have to notify me because your firm doesn't talk to me. Your firm talks to the SEC. I don't know if this hand movement helps, but in my mind, it's like very clear. Like we're going over, across, up, down. Maybe that doesn't help at all. But that's how I think about it. If it was D, a state-regulated investment advisory firm, you still have an investment advisor, so you still have an I, which means you still have one party responsible for notification. But which party is it in this case? In this case, it's the firm. The investment advisory firm has the responsibility when an investment advisor rep leaves or terminates association. If we were an A or B, a broker-dealer, we'd be talking about what kind of employee? An agent. An agent. Does that look like an A at all? I'm not sure. Maybe it does. The A, an agent, tells me who has to provide notification? All parties. All parties. Both the firm and the broker-dealer. And so for those reasons, C is the answer choice because it is the sole responsibility of the individual. What form, bonus question right here, you knew you're getting this bonus question. How many of you already were thinking about this bonus question? What form is the individual going to use to terminate her association? That's the Form 5. High five, see you later. I'm heading out the door. So the Form 5 is that termination. Couple other follow-on questions here. Let's juice this question. For how long would the state securities administrator have jurisdiction over the individual post-termination? For a period of 1 year. For a period of 1 year. And with what and under what time period would the termination of the registration take effect? After 30 days. So a couple ways to juice that question. Question number 2. Let's move on. Question number 3. Which of the following is most likely a non-issuer transaction? So we're looking for a non-issuer transaction. And this is what kind of transaction? Non-issuer is one of what? It's one of our exempt transactions. I'd be looking for an isolated non-issuer transaction typically. But here in this question, they just say non-issuer. So, okay. So that means the issuer's not receiving the capital. They're not receiving the proceeds from the sale of the securities. Somebody else's, not the issuer of the securities, some other shareholder or some other security holder is going to be receiving the proceeds from those transactions. Which of these is most likely non-issuer? Well, I hope that you were able to identify non-issuer is associated with the term secondary offering. A secondary offering means that the parties who are selling the securities, the stock or the bonds, is not the company itself. What's the term that describes an issuer transaction? When the securities are in fact going to be sold for the benefit of, and the capital received or the proceeds received paid to the company itself? A primary offering. So a primary offering would be in B, an additional primary offering. A primary offering would also typically include A, an initial public offering, and D, a split offering, is where we have both primary and secondary shares being sold, meaning we have both the company selling shares and some investors. Now, who are these investors? This could be people like the founder, early investors, angel investors, venture capital, private equity. It could be employees, early employees who were given stock early in the days of the company when it was maybe a private company. And then they sell their shares alongside the company shares. But when we sell their shares, they get the money. And when we sell the company shares, the company gets the money. By way of example, you think about when Facebook went public. Facebook went public back in like 2012. But there were a lot of people who had Facebook stock at that point. Everybody wanted Facebook stock. It was booming. And so when Facebook went public, Facebook sold shares. That was an issuer part of the transaction. But it was a split IPO because Mark Zuckerberg and Sheryl Sandberg and other early investors also sold shares in that deal. And so you have the secondary shares owned by investors, and the company shares, the primary shares coming out. All right, I hope that kind of helped clarify this. For the state law, when we see that isolated non-issuer transaction, we know that's an exempt transaction, and therefore those securities can be sold even if they're not registered in the state. This doesn't go into the isolated part, but it's talking about that non-issuer component. Question number 4. Which of the following methods of registration under the Uniform Securities Act would an issuer who is not eligible for another method use? What a weird question. Classic state law. Classic. You're just like, an issuer who's not eligible for another method. Huh? Well, they're going to start saying, right, as you start unpacking it, you're looking for what kind of registration method? Maybe the most onerous one. Maybe the one that you would use if you had no other choice. And so if you didn't have any other choices to register your securities, what would you probably do? What's your registration method of last recourse that you can always choose if you want to? Qualification at the state level. You can always qualify state by state. I want to sell my securities in New York. I go to the New York State Securities Administrator and I say, what do I have to do to qualify? New York says, you got to fill out these paperwork. We have to make these disclosures. You got to do these things. You do them. New York says you're good to go, but you're only good to go in New York. You might also be able to then take it to New Jersey and qualify in New Jersey following their requirements. Do the same thing in Connecticut. Do the same thing in Pennsylvania. You could choose what states you want to qualify. But why is that going to be the worst choice? Why would you do that if you don't have any other choices? Well, looking at B, coordination, would mean you would coordinate the state's registrations, New York, New Jersey, Connecticut, Pennsylvania, with what other registration? With the SEC registration. And so you're basically bringing all the registrations into a single package. So by registering with the SEC, I coordinate that with New York, I coordinate that with Jersey, I coordinate that with Connecticut, I coordinate that with Pennsylvania, and I have one set of documents going back and forth. So if I can do that, that's what I would do as a preference over qualification because it's going to be less work and more efficient for me. How about in choice C, exemption? Now, exemption's not technically a method of registration, but maybe that would mean I could do what? I could avoid registrations. If I could avoid registration, I would certainly be like, well, I'm not going to register. I'll just sell my securities without registering, as I'm lawfully allowed to do if my securities are in fact exempt. And a notice filing, well, how does that notice filing work? Who are you actually giving notice to? You give notice to the states under the Uniform Securities Act that you are selling securities that are typically exempt, but registered with the SEC. So these would be things like if I'm registered with the SEC under the Investment Company Act, and I'm an investment company, or maybe I'm listed on a national exchange. I might have to do a notice filing at the state. That's going to be a lot less onerous than doing a full coordinated registration and much less onerous than qualifying in the various states. So great question here to kind of begin to put together the different methods of registration. What would my preference be? Maybe I'd be exempt. then maybe I'd do that notice filing, then I would do the coordinated filing, and last but and least option, right, the worst option for me would be to actually qualify in the state. But if that's what I got to do, that's what I'll do. That's what I'll do. Okay, let's jump in to question number 5. Which of the following statements regarding exempt transactions is correct? Make sure if you haven't done this question yet, you pause right here and you dig into these, because this has that legalese, it has that jargon, it is tight in the difference between each of the answer choices. So you really want to make sure you're getting the juice from the squeeze of this question. Is that how you say it? The juice from the squeeze of the question? I'll shut up for a minute. You do the question. All right, have you had a chance to do so? All right, which is the correct statement? What's the most accurate statement? How many of you were able to land on choice A? An exempt transaction is the only way to lawfully sell an unregistered, non-exempt security. An exempt transaction is the only way to lawfully sell an unregistered, non-exempt security. So the security's unregistered, hasn't been registered with the state, and it's not exempt, so it has to be registered with the state. And so I'm looking to that exempt transaction. Now, you know that I always say, if you see only, you gotta be real careful, and I'm gonna be real careful here. We're gonna really make sure that these other choices are not better, because I never like to pick something that has that only, always, never, must, unless I'm really sure about it. Let's take a look at each of the other choices and why they are less correct than A. B, an exempt transaction involves the sale of an exempt security. Is that correct? Well, it could be, but it doesn't follow that it has to be. An exempt transaction is typically going to be due to the nature of the method of sale or the participants to the trade, not because of the security itself. And so an exempt transaction does not always have to involve the sale of an exempt security. It could, but I'm not going to want to go into the exam. This is where I have to do that. What do I want to show the regulators I know? Do I want to show them that I believe an exempt transaction involves the sale of exempt security, that those two things are kind of always the same? I'm kind of reluctant to do that. Instead, I want to hold out that I need an exempt transaction or an exempt security. Not that because I have an exempt security, I have an exempt transaction. That's not correct, which is, I think, the implication of B. I don't love it, because it could, but I'm not sure that that's the choice that I want to show the regulators I'm thinking is most accurate here. Now, what about C? An exempt transaction is the only way to lawfully sell an unregistered exempt security. An exempt transaction is the only way to lawfully sell an unregistered exempt security. So let's unpack that security for a second. What kind of security is it? It's not registered. All right, so we haven't registered it for lawful sale. But what kind of security is it? It's an exempt security. Does that security even have to be registered at all? No, it doesn't. We're talking about treasuries, or we're talking about muni bonds. And on our state law, we have that long list of securities that are exempt under the Uniform Securities Act. We've got that commercial paper. We have those common carriers. We have securities issued in connection with pensions. So utilities, railroads, you got common carriers. All of those exempt securities don't have to be registered, so they're unregistered exempt securities, and they can be lawfully sold without registration in the state, and they don't need an exempt transaction because the security itself is exempt. So C is out. And how about D? An exempt transaction is the only way to lawfully sell a registered non-exempt security. Okay, let's figure this one out. What are we talking about selling right here? A registered non-exempt. Well, wait a minute. What kind of security we got? A registered security. So the issuer has gone through the process of registering it, maybe be via qualification, maybe via coordination, maybe it's federal covered, and it doesn't need that. But this security has been registered with the state, and it had to be because it was non-exempt. And so you don't need an exempt transaction to lawfully sell that registered security because it was registered. A and D are the most similar in that you're thinking about this security that's non-exempt, meaning it has to be registered, or that's D, or sold through an exempt transaction and avoid registration. And that's choice A. So when I analyze all these, I'm kind of between A and B, and then I back up because I'm like, kind of like both of them, kind of don't like either of them. And then I want to kind of say, okay, I'm not going to get to explain myself, but an exempt transaction is the way to sell an unregistered non-exempt security. That is what you do if you have an unregistered non-exempt security and you want to sell it. You got to use an exempt transaction. And an exempt transaction does not always involve the sale of an exempt security. Those are the two different paths. It's not the same path. And for that reason, I'm going with A here. Question 6. Which of the following actions taken by an administrator regarding registration within its jurisdiction is not based on the behavior of the firm or individual? I know I say this every time. This is why we're drawing these questions in. Classic. I did take my glasses off. Does that make me see more clear or less clear? I don't even know if I need those glasses. But I need to really figure out it's a short question, but what are they talking about? Which of the following actions, revocation, cancellation, suspension, or denial, taken by the administrator regarding registration within its jurisdiction is not based on behavior of the firm or the individual, not based on behavior? And then you start beginning to see what they're getting at, right? How many of you were there? Because revocation, choice A, suspension, choice C, denial of a registration application, choice D, are all based on some bad act, some violation of law or rule or regulation that is causing the state securities administrator to say, you can't do business in my state. I'm revoking your registration because you did something bad. I'm suspending your registration because you did something bad. I'm denying your application because you've done something bad. Whereas a cancellation is that action that the administrator takes because an individual can't be located or is non-responsive. And some of you might be saying, but Dave, isn't not being responsive, isn't not answering your mail and your phone, isn't being unable to be located a kind of behavior? And I say, yeah, I understand your point, but I hope that you understand every one of these questions is your chance to show your knowledge. And that cancellation of a registration is not about an individual's behavior. It's not about breaking the rule. It's not about something that you've done that is going to warrant your not being able to practice securities in the securities industry in the state. Whereas revocation, suspension, and denial all have those things. So I hope that begins to clarify a little bit. Again, these questions, be ready for them to be vague. Be ready for them to be a little uncomfortable. Be ready for the question for you to say about that question, man, I wish there was a little more clarification. I wish I could explain myself because I think I'm right there. And that's when you have to fall back on, what do I want to show the regulators I know? And I want to show them that I know that cancellation is different than revocation, suspension, and denial. That's what I want to show them. That's what I want you showing the regulators when you're in the actual exam. Question 7 coming your way. Here we go. Meeting each of the following criteria results in an investor being considered a qualified purchaser by the SEC, except all of the following result in an investor being considered a qualified purchaser by the SEC, except. You had a chance to dig into this question? What doesn't get you to qualified purchaser status? Well, it's going to be an individual with a net worth in excess of $2.2 million, excluding the value of any primary residence. That does not make you a qualified purchaser. Each of the other criteria, A, individual or family-owned businesses with at least $5 million in investments, B, an entity that manages at least $25 million in investments, Or C, an entity where all the owners are qualified purchasers, are the ways that you become a qualified purchaser. That individual with the 2.2 in net worth becomes a qualified client that you can charge performance fees for. That's one of those performance fees criteria, which is distinct from the qualified purchasers. What can qualified purchasers do? Well, they have more ability to buy into more sophisticated, higher risk types of investments. Think hedge funds, venture capital funds, private equity. Those kind of investments are often limited to qualified purchasers, which is a little bit different than our qualified clients. And it's also different still from our accredited investors under Regulation D, which does have a different net worth test, but also brings in that primary residence. One of the things on the state law that's very frustrating for students and for our faculty alike is the overlapping similarities between the different investor types: accredited investor, qualified client, qualified purchasers. So you have, sophisticated, institutional, you have all these different classes, and you need to begin to keep them organized and understood. What regulation does it come from? Is it federal or is it state? What are the entitlements or the opportunities afforded to each of those different types of investors with those kinds of backgrounds? So all of that is to say, it's just valuable for you to practice looking at those definitions, maybe rewriting those definitions, flashcarding on those definitions. The glossary is a great place to check out some of those details when you're going through your materials. Question 8. You've already done the question, right? If not, pause it. Do the question. Which of the following statements regarding exempt transactions is accurate? Another exempt transactions question. All right. So we got 1 accurate statement, 3 false statements. When I get to these kind of all are true, all are false, I'll sometimes write accurate, 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 not accurate, so I can be sure I'm understanding it. Now, in this case, it should be, inaccurate, 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 accurate, because 3 are inaccurate, 1 should be accurate. Which one did you find is accurate? Now, I kind of gave you a little hint on this on one of the earlier questions. See if you remembered it. I'm going to go with D here, that exempt transactions are exempt because of how the securities are sold or to whom they are sold. How the securities are sold. What are some examples? What comes to your mind of how it's sold? How about unsolicited? Right? If it's unsolicited, the nature of that transaction is that somebody came in looking to buy that security. So the risk of fraud, deception, manipulation, abuse is much lower. Because I don't know who's going to just come randomly into my door, who's going to randomly call me and say, Dave, I want to buy that security. So if I'm trying to run a scam or a fraud and somebody randomly calls me and is like, I want to get in on that, that's pretty unlikely. And so as the regulators are balancing the harm, they're saying to themselves, well, if somebody on an unsolicited basis, on their own account, on their own accord decided that's the security I want, I'm going to go and call that broker dealer. I'm going to get in touch with that investment advisory firm to make that purchase. The risk is down, and so we're going to allow it to go forward, even if that security is not registered in my state. What's another one based on the nature of the sale? How about another one we did earlier? Isolated non-issuer. If we see an isolated non-issuer transaction, who's getting the money? Is it the company who's running the books, who's doing the sales, who's telling the stories, who's going on the roadshow? If it's a non-issuer transaction? No, the company's not getting any of that money. It's some other investor. And for that reason, the way that security is sold, that the proceeds don't flow to the company themselves, but to an investor who's cashing out, we are more likely to give leeway there. We're to say, yeah, that's okay for that to be exempt. It's okay for that security to be sold, even though the security itself is not registered in the state, because the party making the money is isolated. This happens rarely. And it's not the company itself. So the ability to do a fraud there goes down. Second part of the answer choice says exempt transactions are exempt because of whom they are sold to whom they are sold. What is one example of an exempt transaction in that regard? Institutions, institutional transactions. Are we as worried about hedge funds, insurance companies, other big sophisticated players not doing their diligence, being ripped off as a party to a fraud? We're a lot less concerned about that. And so we prioritize them having economic freedom and flexibility. They can do the trades that they want to do. And that's why those kind of transactions are exempt. You can look through the list of exempt transactions under the Uniform Securities Act and think on your own about why are we less concerned about that kind of trade, about a transaction that arose in that kind of way, such that we're going to allow securities even that are not registered, that have not made the disclosures to the administrator, where we don't have consents to service a process, where we may not see the disclosures, or those disclosures may not be as forthcoming and as comprehensive as securities that are registered in our state. Well, it's because of how that trade originated or was done or the parties to it. Now, what's wrong with A, B, and C? Why are they inaccurate? A is inaccurate because it says that the transactions exempt, because the transactions exempt, individuals who participate in exempt transactions are exempt from registering as agents. You say, wait a minute. That is an inaccurate statement. Because a transaction's exempt has what impact on the persons, the broker-dealer, the agent, the IA, the IAR, involved in it? It has no impact on that person. We separately run our analysis of, does the person have to be registered? Does that agent have to be registered? Well, that is a different question from, does the security have to be registered? And it's so valuable that you have that differential in your mind. I ask about the agent. Is the agent doing business in the state? Did the offer originate in the state? Was it directed into the state, or was it received from and accepted from a state? And if any of those are yes, I am doing business in the state as an agent, and I have to be registered in that state to do business, even if all of that was in connection with an exempt transaction or an exempt security, because the agent test is separate from the test of, does the security have to be registered? Choice B, exempt securities may only be lawfully sold through exempt transactions. This is really similar to that answer choice we saw earlier. That's not true. If you have an exempt security, you can sell it in any way you want, under any transaction that you want. You can solicit retail investors to buy that exempt security, even though the security is not registered in the state. That's fine because the security is exempt. That's what it allows. You don't need an exempt transaction. And how about choice C? Exempt transactions are exempt because they are distributions of exempt securities. Well, this was basically that answer choice we saw before, and this is inaccurate. They're not exempt based on the security that's being sold or transacted. They're exempt because of the manner of sale or the participants to the sale. So A, B, and C are all inaccurate for those reasons. D really takes it and is an accurate statement of why we have exempt transactions and why those exempt transactions are exempt. Two more questions left. Let's jump into question number 9. An individual performs portfolio management services with a federal covered investment advisor that's active in 16 states. This individual maintains physical offices in states A, B, and C. Additionally, she has more than 5 retail clients in states D, E, and F, and 5 or fewer retail clients in the other active states. In which states must the individual register? What do we think here? What do we think? This is a tough question. This goes into the weeds in the same way that the actual exam will. So what do you think? What do you think? How many of you properly landed on choice A? Choice A. In states A, B, and C, because those are the states where the individual has a physical office, and that is conditioned upon her working for what kind of investment advisor? A federal covered investment advisor. The IARs of federal covered IA firms register at the state level in states where they have a physical office or physical presence only. And the number of retail clients does not matter. If this individual worked for a state-regulated investment advisory firm, if this individual worked for a state-covered investment advisory firm, then she would register not only in states A, B, and C because of the physical presence, but also in states D, E, and F, where she has more than 5 retail clients. And in both cases, in any state where the individual investment advisor rep has 5 or fewer clients, no registration is required under the de minimis test. Be sure you remember it's more than 5 triggers registration, not 5. And so this trips people up that the investment advisor registration requirements differ depending on whether the investment advisor rep works for a Fed covered firm, as the question is written, or a state registered investment advisory firm, which was my counterfactual, my hypothetical. So you can go back to the video lectures where we break that down. First question you got to ask about IAR registration is, what kind of firm do you work for? And then you can deploy the correct test or registration requirements in that manner. So sometimes you see investment advisor reps moving firm to firm. And if they move from a federal covered firm down to a state regulated firm, they may have to pick up additional state registrations because of the location of their retail clients. All right, very good. Last question, question number 10. Which of the following is not a requirement under NASA module rules regarding continuing education requirements for investment advisor representatives? Which of the following is not a requirement under the NASA model rules regarding continuing education requirements? Not a requirement. 3 requirements here. I love this kind of question because you get to leave it and be like, did I know all 3 of those? Did I know the model rules had these requirements for continuing education? And then one of these is not true. So let's take a look. A, are investment advisor reps required to complete 12 continuing education credits per year? What do we think about that? That's true. That's true. Some of you may not have been familiar with that, but that's the way that they lay it out under the NASA model rules, that you need a certain number of credits, and that is 12. You need 12 continuing education credits. B, does continuing education have to be completed by December 31st each year? Is that a requirement? Yeah, that is a requirement. You have to complete it by calendar year end. Now, what if you got registered at the end of the year? What if you got registered in October, November, even December? Get it done. Get it done by year end. Everybody is on a calendar year cycle for their continuing education under the NASA model rules. Choice C. Continuing education credits taken to satisfy FINRA requirements may qualify if approved by the state. So can you piggyback? Can you double dip on your continuing education credit hours so that it meets both the FINRA requirements and the NASA state requirements? That's a true statement. And what do I like about that? You know, I like that may qualify if approved. I feel like there's a lot of flexibility in there. And it is not always the case, but I'm going to say that's probably a true statement. Right? That's pretty varied. A lot of room in there. Leaves me with D. I liked A, I liked B, I liked C, all as requirements. D tells me that it's a requirement that only investment advisor reps who represent state registered investment advisors must complete annual continuing education. What that is saying is investment advisor reps who represent what kind of firms? Federal covered firms would not have to complete annual continuing education. Do you think that the states are going to be okay with that? Do you think the states, even though they dialed it back for the IARs of Fed covered firms, we just saw that on the last question, they dialed back that registration requirement. You think they're going to be like, and by the way, you don't have to do continuing education? No way. No way. And so for that reason, D is not a correct element. Now, maybe some of you are saying, but it's not a requirement, and D is kind of not line up with that. Well, let me invite you to go back to the fact that you don't get to argue your case. Your answers are going to be scored by a computer, an unthinking, uncaring, straight, what is listed as the right answer, and did the person write that down? And what do you want to show the regulators you know? You want to show the regulators you know that D is not a true statement, that IARs representing both state registered and federal covered investment advisory firms have to complete the annual continuing education requirements. And so even if you feel a little frustrated by these questions, or you feel a little frustrated by the questions on the real exam, and that is consistent feedback that we get, what I want you to do is rise up and be able to say, every question, I get a chance to show the regulators what I know. And if you choose wisely, you choose correctly, you don't fight the question, you dance with it. And you allow yourself to get questions right because you're showing the regulators you know the rules, the regulations, and the requirements that they're asking you to do so. All right, gang, that wraps up this review. I hope you got a lot out of it. I hope you're able to juice all those questions, filling some gaps, correcting some misconceptions, turning some light bulbs on. My name is Dave, and I will see you soon for another review session or training session. Good luck as you continue your prep and on your exams.